Hey everyone. Hope everyone there we go. Hope everyone had a good trading day overall. Let me just adjust one thing with the microphone. As always, if there's any audio issues, let me know. Otherwise, you should be able to if there is an audio issue, refresh the browser and there should be some settings in YouTube. Anyways, what the first thing that I want to do here is I'm going to go through and mark up the chart. So typically, what I look at whenever I'm marking up a chart is the first thing I do is I'll go ahead and plot the open of the week. So here's the open over here. And the next thing I'll do is I will take a look at the prior trading day. In other words, yesterday's trading day, which in this case would be last Friday. I'll go ahead and mark the high of the week and the low of the week. And that's what I do every day. Those are the two or three easiest support and resistance to kind of mark out. And then there's other pieces, maybe round numbers. So here's 4,400. I could mark that, but we're pretty far away. And other than that, the next thing I look at is I look at the daily chart. So on the daily chart, we can see that obviously today we gapped up and we triggered a stop entry buy from last Friday. And my one thought was that the bulls would be disappointed. So I thought we would trigger the buy. I did not think the bulls would get a strong entry bar. And obviously today they have, you can call it follow through. We gapped up above yesterday's high or last Friday's high, but it's still a fairly weak bar and it's testing resistance. And on the weekly chart, just to point it out, with last week being such a weak buy signal bar, I suspect there's sellers above. So if we do trigger the buy, we're probably going to find sellers. It's an inside bar, so there's an increased risk that we have to get above this high right here, which was two weeks ago, the high of the prior bear trend bar. 5 minute chart. Let me adjust. There we go. So first bar of the day, we gapped up, and you can call it a wedge if you want, or bull breakout of a channel. 1, 2, 3. Strong enough breakout, bar one. Are we always in long? We might be, but in general, for always in long, I'd rather see consecutive strong trend bars. And then bar two, we have bad follow through. So you can see what happened. We triggered the buy above one, and traders immediately sold it. So we have a stop entry on one so far that has failed. And now we have a stop entry short below two. What do you think is going to happen below two? Well, the reality is there's probably buyers below. On a 10-minute chart, this is pretty much a doji. We sold off on the open of the 10-minute chart. We rallied to the high of bar two, and then we sold off. So this is a doji, and that's an increase. That increases the odds that the market's going to continue to go sideways. 3, buyers below 2. You can see traders, the market tested the low of 1. What about buying above 3? You can, but the reality is there's probably sellers above 3 or sellers at the high of bar 2. And then bar 4, you can see we triggered the high above 3, but we found sellers. So we have 2 stop entry buys and 2 possible stop entry sells. You can call it a triangle, but overall, there's an increased risk that the market's going to have a lot of trading range price action. Bar 4 or bar 5, we broke below 4 right here. Strong enough breakout, we may get a small second leg down. Now, as far as selling the close of bar 5, it's a little bit problematic because it's technically a second leg down from the sell off from the 2 high to the 3 low. So it's possible in a smaller time frame this is a second leg trap, leg 1 pullback, leg 2, and a failed breakout below 1. So if I had to do anything, what would I do? Would I buy or sell the 5 close? I don't know. I probably would buy the 5 close, but this is buying fairly high into the bar, and there's probably sellers above 5. So there's probably buyers below 5 and sellers above 5, and you're really doing something in the middle. You have bulls who bought the 4 low and scaled in lower. How do you think they're feeling on the close of 5? If I'm a bull and I bought the low of this bar and more lower right here, I'm probably disappointed enough that I'll look to sell out of my longs at the low of 4. 6, we have a bull bar, so traders bought the close. You can call it a failed breakout below a triangle. Doesn't really matter. It is a triangle. 1, 2, maybe 3, or 1, 2, 3. But you're in the middle of a very tight trading range. And so far, you've had a stop entry buy, stop entry sell, stop entry buy, stop entry sell. And now you're getting a stop entry buy. Eventually, one of these stop entries will work. But if you take every one of them, you're going to get chewed up. And even if you catch the one stop entry that works, you will probably have dug yourself in such a hole that it's not worth doing. 7, we have a doji. So the bulls, they bought above 6 on 7, but look what happened. The bulls failed to close above the 6 high, and that increases the risk that the market's going to go more sideways here. 8, we have an inside bar, so breakout mode. 9, we broke below 8, but we went sideways. And 10, we have another inside bar. So this is obviously a contracting range, and because of that, you're in breakout mode, and the odds are there's probably a 95% chance that we're going to get a measured move up or measured move down. At the moment, I think we may have to test yesterday's high, and the reason for that is it's a weak buy signal on the daily chart. Okay, there we go. Just wanted to fix something. So 10, we have a doji, and then 11, we finally got a bull breakout of the tight trading range. Are we always in long? I think so, based on the gap. We broke to the upside, we pulled back, we're getting a second leg. So far, good bar on 11, but what will 12 look like? 12 is a weak bull trend bar. It's possible double top with 4 or 2. You will have some bears who sell the close of 12 and they put their stop maybe a point above the 2 high. Some traders will just put it one tick above the 2 high, hoping this is a trap. And you can call it a second leg trap, leg 1, pull back, leg 2. But in any regard, they want a double top and a measured move down. And let's see here. The high of 2, 47 and a quarter. And the high of this bar, 46.75. So we have a double top with 2 and 13. What about selling below 13, betting on a double top? Some traders will. I would not. And in this case, 14, we broke to the downside. So some traders, they bought the close of 11, disappointed with 12 and 13. They started selling out of longs. And that's what happened on 14. 14, enough of a surprise. We may get a small second leg down. Is it always in short? I don't think so. But if 15 is another big bear trend bar, we will probably be always in short. 15, bear bar, but close around the midpoint in the open of the day. Not quite always in short, but certainly a problem for the bulls. And then 16, now we have 3 consecutive bull bars. We have a gap, the low of 13, high of 15. We have another gap, the low of 14, and the high of 16. So that is a sign of strong bears. And then 17, we had another downside breakout in a test of Friday's high. Good for the bears, always in short, yes. But look at the bars. Big bar on 14, smaller bar on 15, small bar 16, and a big bar on 17. It's possible that's a warning that this is climactic and the market will start to go sideways. And then 18, we have a big bull trend bar. What about buying above 18? Excuse me. What about buying above 18, betting on a failed breakout below 1 or 5? Some traders will, but you're buying after a micro channel all the way down to 17. and 18 is an inside bar. Low probability buy, okay to exit shorts above and look to sell again below lower. With the size of 18, I suspect there's buyers below any pullback, so we may have to get a small second leg up before the bears come in. 19, low one short, but probably buyers below 19, scaling in lower. Some bears, they sold the 17 close, disappointed on 18. You know, those bears will probably use 19 to buy back some of their shorts. And you can see 20 broke below 17, but look at the bar. It's a small entry bar and with the big tail below. That's a warning that you had more traders taking profits below 19 and bulls buying below 19 and bears buying back shorts below 19. Same thing with 17 over here. 21, three consecutive bear bars. For the bears, they see a breakout below 19 during 20 and they see a pullback on 20 as well. So it's a breakout, pullback, short. They're hoping that the bears give up below 21, and they might, but tail below 19, tail below 20, tail below 21. 21's an inside bar, and it's a possible one bar final flag. 22, another inside bar. So again, II, consecutive inside bars. It's a triangle on a smaller time frame. And if we break to the downside and reverse up, you will have some bulls starting to buy. 22, 23, we went above the 21 high and reversed down. Tight trading range. Really better to do nothing. The market's stalling at yesterday's high and it's deciding, are we going to break below yesterday's high or are we going to find support at yesterday's high and bounce? With the sell-off, I suspect the sell-off down to 22 is strong enough for at least a small second leg down. However, if we do get a second leg down, we'll probably get bought. '24 outside down. We had sellers above and probably buyers below. Probably going to go more sideways. 25 an inside bar, and then 26 we have a decent entry bar. But look at the tail. We had a tail above 25, tail above 26. It's a test of the 18 close. You had some bulls who bought a pullback of 18 during 19 and they got trapped on 19. And look what this is doing. This is relieving those bulls. So this might be more of an area of selling above 25 and the 24 high than buying. Surprise bar 27 may go a little bit lower, but it's a second leg down from the sell off down to the 20 low. And with all the sideways trading here, it's a possible. So with all the sideways trading here, it's a possible final flag. And you may have more traders buying back shorts here and bulls scaling into long. For the bulls, it's three legs down, 1, 20, and 27. They're hoping that the next bar is a big bull trend bar. With the size of 27, you have bulls who got trapped who bought the 26 close, the 26 low, scaling in lower. This bear bar on 27 is strong enough for at least a small second leg down. So the bulls that bought the 26 low, for example, and bought more lower on the way down are probably disappointed enough that they will look to sell on any pullback and retest of the 26 low. 28 inside bar, probably buyers below scaling in lower. For the bears, they see it as follow through, but the market failed to even fall below 27, much less close below 27, and it's too much risk for the bears. The risk for the bears is three legs down, 1, 2, 3, or a second leg trap from the sell off down to 17. You can also call it three legs down from 17, 20, 20, and 27. 29, we have a bull bar, micro double bottom, down on 27, up on 27, down on 28, up on 29. Okay, swing buy for the bulls. For the bears, I would certainly get out of shorts above the bar. Aggressive bulls will buy. 30, we have a bull bar, decent follow through for the bulls, strong enough a bar and enough of a surprise. Trapping the bears who sold above 29, scaling in higher on 30. We'll probably get at least a small second leg up, and we'll probably have to test the 27 close up here. 31, It's an inside bar pullback from the breakout on 30, probably buyers below 31, scaling in lower. 32, bull bar, second leg up after 30. Bad follow through for the bulls on 31, so some of the bulls during 32 sold out of longs. 33, we have a close above the bars to the left, a micro channel since the 29 low to the 33 high. Good for the bulls, probably going to go at least a little bit higher. And then 34, we have a bear bar closing on its low. For the bears, it's a possible wedge. We went up on 28, down on 29, up on 30, pulled back on 31 or 32, and then we rallied on 33. Other bulls will see it as a two-legged pullback, leg one, pullback, leg two. This is also the area where traders got trapped. You had some traders and do it like this. You had some traders who bought around the red line, betting they bought a pullback of 26 and they got trapped on 27. And you can see the market's testing that price level and it sold off on 32 or 34. Okay, swing buy below 34, but probably buyers below, which means probably not going to break far below 27 if we get there. 35, bear follow through, but a weak entry bar for the bears that sold below 34. Probably sellers above for at least a small second leg down, but also probably buyers below scaling in lower. 36 bull bar, but a weak bull bar. Still probably buyers below 36, scaling in lower. 37, we have a doji, probably going to go more sideways. For the bears, it's a wedge. 20, 27, and it's really a truncated wedge. We went down, second leg on 27, third leg on 36 or 35. And then bears giving up on 38. Strong enough bull bar. We may go at least a little bit higher, probably strong enough to get at least a small second leg up. So some bulls will buy the close, hoping that we vacuum up to the open of the day, open of the week. Follow through bar 39. The bears that sold above 37 got trapped on 38. And you can see what happened. You can see what happened at the low of 39. It formed a gap. So bears, they sold the high of 37. They got trapped on 38 and they tried to get out of 39 low, but they failed. 40, bear bar, inside bar, possible second leg trap, leg one up to 32, pull back on 35 or 36, second leg up on 39. But a weak stop entry sell, probably buyers below. 40 is a doji and it's a low probability sell below the bar. And because of that, you may have more traders buying below 40 than selling. 41, the bears failed to trigger the sell below 40. Good for the bulls. Is it by the close? I think so, but you're really close to targets above the open of the week and this area over here. It's possible we still have to get up to the 12 or 13 low and maybe the high of the day. Good follow through, 42, probably by the close. Possible parabolic wedge up on 36, pause on 37, up on 39, pause on 40. And then a third leg up to the 42 high. 43, still by the close, but getting near resistance, the high of bar 12, the low of bar 12, and the midpoint of this big bear bar. Still probably okay to buy the close, and the first reversal down will fail. 44, we tested the high of 13 and pulled back. Probably going to get at least a small second leg down. The sell off from the high of 44 to low of 44 is strong enough that the first reversal up will probably fail and the bears will probably get a small second leg down. Still tight bull channel from the 36 low to the 44 4 high that I suspect the first reversal down will be minor. 45 bear bar, but probably sellers above 45. And then 46, we went a little bit lower, but probably buyers below 43, buyers at the midpoint of 42, scaling in lower. 47, we have a bull bar. We triggered the buy above 46, but probably sellers above, scaling in higher. I suspect we're going to go mostly sideways here. 48, we triggered the buy below 47 and bulls came in. You had some bears who sold the pullback of some bears that sold above the 46 high right here during 47. And a lot of those bears took profits down here. 49, we have a pullback or a doji. We rallied on 47, pulled back 48, second leg up on 49. For the bears, they'll see a second entry short, but weak looking signal bars, probably buyers below, scaling in lower. 50, surprise bear bar, strong enough bar will probably get at least a small second leg down. The bulls that bought the 49 low and scaled in lower, they're probably disappointed enough that they will look to sell out of longs on any pullback. And the bears know this. So what are the bears going to do? The bears will look to sell and sell any pullback, trying to trap the bulls. If the bears are lucky, they will prevent the bulls from getting back to the 49 low. For the bears, it's a possible bear breakout below a bull flag being this area right here. The bulls tried to create a pullback and a second leg up from the rally up to 44. And instead, the bears are getting a downside breakout. Even though there's a tail below 50, the bears will see it as a pullback from the downside breakout from the open of 50 to the low of bar 50. 51, follow through bar, failed to close below 50, but it at least broke below 50. And that's a sign of strength by the bears. For the bulls, if I was long, had I bought below 49 or during 50, I would exit longs below 51. Too much risk that this is a second leg trap. Leg one, pullback leg two, and a test of the prior highs from earlier in the day. 52, 3 consecutive bear bars, probably always in short, but not that clear. And then obviously the market became always in short on the open of the current bar, big surprise, probably going at least a little bit lower, but it's a climactic bar, and that will lower the probability of traders selling the close. 54, follow through bar after 53. And by the way, whenever I say it'll lower the probability of traders selling the close, what I mean is there's an added risk that the market bounces maybe 50% of the bar and then sellers come in. This is still strong enough that you will have traders selling and looking to sell higher. It's just a question of will traders sell the close or will traders try and sell with the limit order above the bar. It's the same thing with the 17 bear bar over here. We're always in short. It's enough of a surprise. We're going to get a second leg down. But the question is, will the bears get a pullback first? So, in other words, will the bulls get a pullback first? So, instead of selling the close, you may get a pullback all the way to the 16 low or the midpoint of this bar. And that's what happened on 18. But the market still got a second leg down. So, that was my concern with this bar right here. Because this is a possible second leg trap, leg one, pullback, leg two, we may have to test all the way down to the 36 low before the bulls come in. So bear bar 54, still always in short, but we had sideways bars here, big bar, big follow through bar with the big tail below 54. So ask yourself, if 54, if the market is strongly bearish, and you can argue it looks strongly bearish, but look at this bar. We have strong follow through after a big bear bar, but why did bears buy back shorts into the close of 54? If the bears were so strong and so determined to drive the market lower, you have to ask, why did this happen? So what do you notice right here? The low of 27 is 23.75. The low of 54 is 23.25. So what that tells me is you had a lot of bears who, instead of selling on a stop one tick below 27, hoping that the market plunged down maybe to yesterday's close, maybe lower, instead, you had bears looking at this and saying, yeah, this might just be a sell vacuum test of 27 low. So I'm going to be smart and exit my shorts at the low of the day rather than selling into the low of the day. And that's exactly what traders did with 54. 54 strong enough bar that I suspect the first reversal up will fail and will probably fall at least one tick below 54 at a minimum. 55 doji, probably buyers below 55, and we may go sideways, but probably sellers above 55. What we don't know is 55 is we know 55 is an inside bar, and because of that, that increases the risk that the market will get above the 54 high. So instead of selling the 55 high, you may have more traders looking to sell above 54. Good bar for the bulls on 56. It's follow through buying, and the market closed above 54. But for the bears, they'll see it as a buy vacuum test of the 54 high. And when I said good bar for the bulls, I meant it closed above 55. 57, you can see traders sold the close of 56, but probably buyers below 56 and 57. And the bulls will probably get a second leg up on 58 or 59. 58 consecutive bear bars testing the 54 low. Good bar for the bulls on good bar for the bears on 58. But look where we are. We're right at the 27 low and near the 54 low. And there's an added risk that there's more buyers down here than sellers. 59 inside bar. What about buying above 59? I would not. I think it's okay to exit shorts above 59, but probably better to wait. Tight bear channel down to 54 and probably going to go sideways. 60 bull bar, possible buy vacuum test of the 56 high. 61, we have an inside bar, probably buyers below 61, probably sellers above 61. We're far from the moving average, so we may have to get there. And then 62, we broke to the upside and pulled back. For the bears that sold above 60 or 61, obviously disappointed with 62. You may have some traders who sold up here and they scaled on higher and they're looking to get out around break even in here. 63 inside bar for the bulls. We broke out on 62. And let me re-explain that. You have bears who sold the high of this bar and they look at 62 right here and they see this as a disappointment bar. And because of that, because they're disappointed with 62, because they're disappointed with 62, the bears, they sold and scaled in higher. They might look to buy back shorts here. So the bulls, they might see 62 as a pullback from the breakout above this bear flag right here. 63 inside bar, so it's follow through after 62, but it's weak follow through. Probably sellers above 63, but if there are buyers above 63, we can vacuum up to the open of the week. Would I sell above 62? I would not. It's in the micro channel since the 58 low. And again, it's possible this is a bull breakout with a pullback on 62, and this 63 is a retest of this price level. So it's possible that we break out above 64 inside bar, not a great sell below, and the bears So the bears aren't doing enough, but the bulls have yet to get a strong upside breakout. 65 bull breakout, closing bull bar, closing on its high. Good for the bulls. Are we always in long? I think so, but it's not really all that clear. For the bears, they see it as a wedge, rally on 60, pull back 61, rally on 62, and a pullback on 63, and then a rally up to 65. Even if 66 is a bear bar closing on its low, it would be selling in a bull micro channel. And because of that, this makes the parabolic wedge 1, 2, and 3 likely to be minor, and probably which means probably buyers below. 66, we went outside down. We triggered the buy above 65 and we triggered the sell below 65, and then we reversed up. You had some bulls who bought the close at 65 and bought more below 65, and they may get out around break even, but still no sign, no decent stop entry short for the bears. 67 bull bar, and then 68 a follow through bar, tested the open of the week, bull breakout to the upside, probably by the close, but parabolic in nature, and we're getting near resistance. The open of the week, the 52, the 50 low, 51 close, and the 46 low right here. So the upside is probably going to be limited. 69 inside bar, probably buyers below, scaling in lower, but I think it's okay to get out below any bear bar at this point and wait for the market to go sideways. Too much risk that the bears may get a small second leg down. '70 weak entry bar after 69, probably buyers below, and then 71 followed through. So the bears, they had a bear breakout on 69. We have a bull bar and then a trend line break on 69. We went sideways for one bar and we got a bigger trend line break from the rally up to 68. Three consecutive bear bars, but it's possibly two legs down. We sold off on 69, paused on 70, second leg down on 71. And this is an area where bulls might start buying. It's an area where bulls might begin to buy. That is sort of similar to over here on the weekly chart. We rallied. We have a bear bar right here on the first week of August. And then the second week of August, we have a smaller bear bar. So it's a breakout on the first week of August, August the 4th, and then a pause on August the 11th, and then a second leg down on August the 18th. So it's two legs down. We may get two small legs up. But anyways, right here, probably sellers above 72, but also probably buyers below 72. And 73, we have a bull bar, probably sellers above, but the rally up to 68. The bulls, even though you can argue the sell off down to 71 looks stronger than the rally up to 68, the bulls on the 68 rally were able to control the market in terms of time. It was a micro channel lasting a lot of bars, and that will increase the probability that the market goes sideways. You had some bulls buy the 68 close and more lower. So this is, and because of that, they may look to sell out of longs up here. And that's what happened on 74. 75, we went outside up, probably going to go sideways. And instead, we broke above the 646 high, and that relieved the bulls who bought the 46 high, even the bulls that bought the high tick on 46 and more lower were able to avoid a loss on 76. And then the market went sideways for the rest of the session. For always in, not really clear with any of these bars. Would I buy above one? I would not. I probably wouldn't sell below two either. because you know the bulls that bought above one and more lower probably going to be able to get out break even. But you also know the bears that sold below two and sell more higher will probably be able to get out break even. So this is not really all that ideal. If you buy above six, it's you're buying in the middle of a tight trading range. And had I bought above six, I'd probably gotten out break even on the entry bar or the following bar. And that's really the same with any of these bars over here. Better to wait for an upside breakout or a downside breakout, or in other words, we have a tight trading range. It's better to wait for a successful breakout of the tight trading range. In other words, a successful breakout of the triangle, or it's better to wait for a failed breakout of the tight trading range, which you can also call a triangle, and then a reversal. Here, we had a failed bull breakout and then a reversal down. I thought it was always in short on the close of 15 or 16, so probably an okay sell the close environment. And you don't have to get out above 18. Some traders would. Other traders would wait for two or three consecutive bull bars. I would get out of shorts above 25. Had I gotten out of shorts above 25, what do you do on 27 or 28? I think I think it's pretty difficult to sell down there. Too much risk of a possible wedge, and you're selling pretty late in what looks to be a leg in a trading range. Bulls buy above 29. Bears probably exit shorts above 29. I'd get out of longs below probably 34. Bears can sell, but if they do, they probably get out above 37, certainly during 38. And on 38, 39, bulls can start buying. Okay to get out of shorts below 45, possible double top with 13 and 44. So it's okay to get out below 45, betting on at least a small second leg down. And that's in essence what happened. But however, in this case, we got a very big second leg. Leg one, pullback, large second leg down. Leg one, pullback, large second leg up. I think it's okay if you were still long to get out, maybe a measured move down of 49. So once you start to see 50 break to the downside, reasonable for bulls to get out. Other bulls get out on the 51 close, and bears start to sell 51 or 52. Down here, bears, I'd get out of longs. I'd get out of shorts above 59 for sure. Bulls, they can start to buy. And bears probably get out below get out below 69. Bears can sell, but tight bull channel, I would not sell here. And bears get out above 72 or 73, and bulls buy, and that's pretty much it. For limit orders, lots of limit order trades. Traders buying below bars, selling above bars all through here. And once the bulls got trapped during 14 and 15, you had bears selling any pullback they could, selling really above anything. Then we went sideways from 18 to 26. Bulls started buying below bars, scaling in lower, and probably sellers above 46 for a second leg down, and then probably buyers below down here for a second leg up. And that's pretty much it. I mean, there's more limit order trades than that, but those are just kind of some of the few. Buy the close, sell the close, probably 15 or 16. And 27, is it buy the close, sell the close? I don't know. If anything, I thought 27 might be more of a buy the close bar, but reasonable to get a small second leg down. So I don't think you have to buy the close 27. And probably better to wait for the bull bar on 29. If you were a bear and you sold the close 27, reasonable to get out above 29. That's why a lot of traders wait for stop entries. And then 38, 39, probably buy the close 41, 42, 43, even by the close 44, but 44 getting dangerous. The bar on 44 has a big tail above, and there that increases the risk of a second leg down. Probably sell the close 41, 42, and then probably sell the close on 51, 52, 53. What about 54? I don't know. I would not. It's selling pretty low in the range. But if I did sell the close at 54, I'd be quick to get out, break even in this area. And then 63, 64, 65, it might be by the close, but not all that clear. And then 68 or 60, 68, is it by the close? I don't know. I think it's more of a parabolic wedge, and I'd rather wait for a two-legged pullback. And then that's pretty much it for buy the close, sell the close. Maybe 75, but I think it's too late in the day. Okay, let me take a look at a few questions. Question: what are your thoughts on buying above 63 during 65 for a scalp? So, what are my thoughts on buying above 63 here during 65 for a scalp? Oh, okay. I see. So what they're saying is what are your thoughts on buying on a stop above 63 during this bar? I thought it was okay. This is kind of one of those always in type of trades where I don't know if it's good enough for a scalp. For me, if I'm whenever I'm buying or whenever I'm looking to do anything, I'm always asking myself, what's the always in direction? Where's the bias of the market? And right now, the bias is to the downside. Obviously, the bears are failing. They're not doing enough, and the market's starting to go sideways to up. But my one thought here is it's not clear that the bulls have won. And because of that, if I'm looking to buy, I'm thinking about this. I'm thinking about the possibility of a bull breakout above a bear flag. So we have a sell off, we have a pullback, and it's pretty common to get in trading ranges to get bear breakouts below bull flags and bull breakouts above bear flags. So, like, look over here. We have a pullback after a strong rally, but it's climactic, parabolic. One, two, maybe three. It's a second leg trap. We rallied to 33, pulled back to 37, second leg up to 44. And whenever you start to see the market go sideways like this, you always have to wonder, is this going to be a bear breakout below bull flag? And if it is going to be a bear breakout below bull flag, we can quickly race down to the bottom. So if I'm ever selling, like right here, I'm not going to sell. There's two ways I'm going to handle the trade. If I sell and scalp out for 3 or 4 points, I'm prepared to sell again, as soon as I get a close or another bear bar. So, for example, if I sold this close, and in this case, it wouldn't have worked out that well, but had I sold this close and scalped out for 3 or 4 points, and then the market's all the way down here, that's kind of a tough call. It's climactic. And because of that, I would probably look to sell a pullback. But even over here, this is kind of the same example. We have a spike and then a channel. The bears, what are they trying to get? They're trying to get a bear flag and lower prices. And then look right here, 38, 39. Something is not right for the bulls. So if I'm buying, let's say, the close of 38 or 39, I'm really hoping for a surprise breakout in a rally to a new high of the day. Now, there's two ways I'll manage it. If I think there's a really good context, I'm willing to hold for multiple bars. But a lot of times, what I end up doing is buying and scalping out. Buy the close of 39, scalp out for 3 or 4 points. And in this case, wouldn't get filled. I'd get it filled here. I'd be out of the trade before this bar closed. So if I bought this close at 32.25, the market's at 36.75. So I would have been able to get out for 3 or 4 points. Had I gotten out, what would I do on this bar? Well, I would buy again, probably. It's a strong enough bar, probably going to go higher. Had I bought this close and then I got filled for 3 or 4 points again, what would I do on the close of this bar? If I was flat, I would buy again. That's more work, but you end up capturing The risk is kind of like over here. If I sold this close and I got out for maybe 3 or 4 points on 34 at 34 even, I might miss out on 4 extra points down here. But anyways, back to your question. Had I bought above this bar, I'm probably not going to scalp out. And if I am going to scalp out, I'm going to be very quick to buy again. And the way I look at this is I'm always counting legs. Leg one, pullback, maybe leg two. But what did I say about this rally? I mentioned it was a micro channel, and the bears are not getting good sell signals. They're having a hard time selling. Had I sold the 60 high or the 61 high during 62, I'm disappointed. And look what 63 and 64 are doing. So I sell the high of 61 or 62. I sold the high of 60 or 61, and then look at 62. That went really far against me. So if I sold and scaled in, look what happened at the 63 low. The low of 63 is 28 and a half, and the high of 60 is 28.25. So there's a gap right here. The bears are trapped. And if I think the bears are getting trapped, I'm going to buy hoping for an upside breakout. So if I see a bar like, let's say this bar right here, bar 65, and I'm still long, it doesn't matter if I bought the 59 high or if I bought up here or or if I bought your trade above 63 or if I bought the 65 close. I'm going to manage it all the same way. If it's a possible parabolic wedge and then the next bar is a bear bar closing on its low, I might get out. But let me read your question. I was convinced we were going to the 52 low right here. Okay, I think that's reasonable since there were trap traders there and it was a trading range day, so they should get out. Yeah, I think if you're buying, I think in trading range days, the problem with trading range days is it's by the time it's clearly always in short, there's not a lot of downside. There's not a lot of room left in the move. A good example is 52 or 53. It's a big bear bar closing on its low. And you're thinking, yeah, we're always in short. But look at the bar. It's climactic and it's forcing you to sell really low in the range. By the time you buy a strong breakout and follow through on 42, you can't even get a measured move up of these bars. So the upside is limited. By the time you look at bar 17 right here and you say, yeah, it's always in short, new low of the day, four, decent sized bear bars, but it's parabolic and there's a greater risk of a deep pullback and then a small second or third leg. So that's very common. So for me, had I bought here, I think it's okay to get out at the 52 low. Other traders might hold. You can see what's happening. 67 tested the 52 low, and then 68 broke higher. But a lot of traders, I'm always thinking about the always in traders. Even if I'm not necessarily trading always in, I'm always thinking about the always in bulls and always in bears. Always in bulls, they buy anywhere and they trail their stop. And there's really no reason for an always in bull to exit their longs yet. Therefore, you don't have to, you really technically don't have to be flat at the moment. Bear bar 69, some bulls might exit, but the channel up so tight, this might be a small pullback trend. And then if they got out below this bar, or some bulls, if they got out here, they might have to buy again right here. But that's the problem. If you get out below this bar, in theory, you have to buy again right there. So I don't know if I'm answering your question, but trading range days, usually you're better off scalping out and looking to re-enter. Was it reasonable to buy above 12 a trading range breakout? Okay. So is it reasonable to buy 11 or 12? I think it's okay. But for me, this is how I think about it. If I see a big bar like 11 right here, I see a big bar and it's forcing me to buy high. I want the follow through to be really strong. So I want to see this. I want to see 42. I want to see a bar like 42 after 11 and 12. Does that look all that strong? If the bulls who bought above 11 see bar 12, that's pretty disappointing. And because of that, you may have a lot of traders who will be pretty quick to exit. The pullback on 12 is a trend line break. We rallied on 11. We pulled back on 12. So that broke a bull trend line. And then we rallied on 12. And it's still a possible lower high. And whenever you're in a trading range and you see bars, you see a possible lower high, like the 12 high compared to the 2 high, you always have to be concerned about a second leg trap. Let me see if I can do it like this. We rallied, pulled back, and look right there. Leg one, pull back to the 9 low, leg two up to 12. And it's no surprise. If I snap this to the low of bar 5 and the high of bar 7 and the low of bar 9, the leg one, leg two retracement takes you to 47.25. And look at the high of this bar, 47.25. And it's no surprise that corresponds right to the high of bar 2. So the computers knew that this formed a leg 1, leg 2 and tested the 2 high perfectly. It's really important to remember that most breakouts, all breakouts are vacuums, and sometimes the breakout's so strong that you don't know where the vacuum is going to lead. But all breakouts are vacuum test of support and resistance. And a lot of times, such as trading range days, you get this magnetic effect where you get this sell off, strong second leg, and then it reaches some target and then it melts away. You get a rally, pullback, second leg, third leg, but then it tests the midpoint of bar 11 and then reverses down. Here, you had a sell vacuum test of the 24 low or the 23 buy signal bar high, and as soon as it touched it, the market reversed. But whenever I think it's a trading range day, I'm really quick to get out. So if had I bought above a bar like 12 and then I see 13, I'm going to be really quick to get out, especially if I see 14 start to sell off. The way I think about it is this. If I'm buying above 12, where's my risk? Maybe I put it below 11. But if my stop is at the 11 low, what's the probability that the market goes all the way up to 44.54 before I get stopped out? Maybe there's a 60% chance on 12, but there's not a 60% chance on 13. Therefore, my math's bad, and I've got to be pretty quick to get out. Question, Brad, today I tried to buy below 39 initially. So I tried to buy above 39 right here. Excuse me, I tried to buy below bar 39. Initially, I would target 2 times my initial risk. Would it be okay to also target 1 times the initial risk? Well, yeah, I talked about that. I think the bull's buying here. You have to sense what's going on here. Trading ranges, it's really common for the market to not allow limit order traders in. And because of that, it forces traders to chase the market up too high. So you see this and you say, gee, that looks really weak. And, I don't know. I don't know if I want to buy the close. The market's not really going straight up. It's a weak signal bar above 36 or 37. Or you can say it's a weak signal bar above 35. Big bull bar on 38, but weak follow through 39. Something does not look right here. And then you get this doji and you think to yourself, yeah, I'm going to buy a pullback. This looks like we're going to pull back. And who knows? Maybe I'll get lucky and I can buy the 39 low. So I'm going to set a limit order here. Al says that inside bars are contracting bars and there's a greater risk that the market breaks out above or below an inside bar. So I'm going to try and buy down here. And then look right here. The market didn't even allow you to enter. So for me, if I'm ever trying to buy below bars and the market keeps going up and eventually you get a bull bar closing on its high, and I look at that and I say, gee, that's a surprise. That shouldn't have happened. I'm going to get long. And for me, I would buy the close. And worst case, maybe you buy the close and you put a stop below the bar. Worst case, you get stopped out. So that is how I would look at that. Question, how did the moving average inform or assist your trading decisions today? I find that most days it just confuses things, even in retrospect. I can't see I can't seem to see how it helps at all. Well, yeah, so for me, the moving average, I find the moving average more helpful on trend days. So how do I use the moving average? The first thing you have to think about is what is a moving average? A moving average is, and this is I'm stealing this from Al. So I'm going to give him credit for saying this. He used to say it in the trading room and he still does. The moving average is a reflection of the fair price. So if you think about it, that means that if you have a 20 bar moving average, at this point, this line is the average price over the past 20 bars. And obviously, if it's exponential moving average, it's a little bit different than a simple. But in any regard, right here, this line on, let's say, the close of 9, this moving average tells me that, hey, the market says the fair price is right here based on this moving average. And right now, the market's forcing me to buy far above the moving average. Let's use bar one as a more extreme example. So right now, the moving average is all the way down here. This is the fair price. And the market's all the way up here. And then you start to see the market go sideways. Do you really want to buy far above the moving average if the market is going sideways? So think about what that means. Traders are happy to buy far from the moving average when there's a reason to buy far above the moving average. The momentum is strong. There's a sense of urgency. It's kind of like buying high. You're willing to buy high. You're happy to pay for something that's expensive if the demand seems to warrant paying very expensive for it. But if the market's going sideways, this is not where you want to buy high. So trading range days, the way I look at it is typically the market's going to go above the moving average and then it's going to crash below the moving average and then it's going to start to go sideways. And then right here, the market keeps trying to hold below the moving average, but you can see it's doing a pretty poor job. And then we break far above the moving average. Now look right here on this bar right here, 44. 44 is forcing traders to buy really far from the moving average. Do you really want to buy far from the moving average in a trading range day? No. If you look at the reason why trading range days operate the way they do is it's climactic behavior. By definition, climactic behavior, think about it, climactic behavior leads to trading range price action. It's by climaxes. All day long, you get these big bars that are climactic and go sideways. Big bar leads to a little bit lower, and then you get a big bar and bad follow through. Look all through here and you see bad follow through, big sell off, bad follow through, big bull bar. We had follow through, but then look, it went sideways for several bars. Big bear bar, follow through, but then bad follow through for a lot of bars. And that's due to climactic behavior. Let's see. Look right here. This is somewhat climactic, big bars, but they're somewhat uniform. So it's a little bit more sustainable. Here is an even better example of sustainable bars where we rally and then we go sideways for several bars. We rally and then we go sideways for 10 or 20 or 30 bars. And then we rally and then we ended up having to get pulled back to the moving average. But the point I'm making is whenever the market looks like this and you're above the moving average for a lot of bars, that's a sign of strength. Here, we're above the moving average for several bars. That's a sign of strength. This actually, this is a lot of bars. Trading range days don't do that. We go above the moving average for 13 or 14 bars, and then we break below. We go below the moving average for 13 or 14 bars, and then we break above. And it just alternates back and forth. Okay, that is all the time I've got for today. So thanks everybody for watching. And there will be more end of day reviews to come in the future. As far as tomorrow, I will be in the trading room. So the end of day review will be for the trading room subscribers. But Wednesday, there will be another YouTube end of day review. All right. Thanks everyone for watching, and I will talk to everybody soon.